Hello, everyone. My name is Diane Donnelly, and I am with the Donnelly Group of Keller Williams Flagship of Maryland. And I run a little team here in the Annapolis, Maryland area. And we are going to be talking with Pablo Alvarado today. He is a certified financial planner and registered principal at LPL Financial here in Annapolis. And this series was brought about because people had so many questions going into COVID and all the changes that, that happened. And we know that there is so much information. In fact, I think the doctors today said that there's more misinformation on social media about COVID than there is real information. So the series was brought about to bring some real information to you from some of our valued vendors and contractors and lenders and all of our partners. So today, Pablo is going to speak to us, and every market has its opportunities, and COVID has disrupted a lot of different segments, a lot of different areas. The stock market being one of them. And if you haven't gotten into the stock market, or you've been afraid to get into the stock market because you don't know what you don't know, today's call is for you. We're going to talk about stock market basics. And Pablo, if you would, just tell us a little bit about yourself and a little bit about LPL, and then we'll jump right in.
Awesome. Well, thank you for having me. It's good to be here with you again. Pablo Alvarado, I'm a certified financial planner with LPL Financial, and I proudly serve 150 families, not just in Maryland, but throughout the country. And I help them, basically create the vision, their individual vision of financial success. And everybody's goals, everybody's visions are unique to them. I also help their family members to do the same. So I always ask people, what are your goals? What is that vision like? And then we go from there and we create an individual plan. Personally, I live here in Annapolis with my beautiful wife and beautiful daughter, Olivia. We've been living here since 2012, and Annapolis is home.
Annapolis is home. It's a good place to call home, isn't it?
It's beautiful, beautiful.
Good. Well, welcome. So,
thank you.
Pablo, let's start really basic. What is the stock market?
Yep. If you think of the stock market is basically, in its simplest form, it's basically a place where people come together to trade things. In this case, we're trading stock for money. In the more complex approach to it is companies trading stocks with each other sometimes, but it's where people go buy, sell, or trade stocks.
Okay. And then what is a market index?
Market index, that's a great question. A market index is basically an indicator of something. An index is something that measures something. In this case, the stock market's got several indices. But three of the major ones is the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. They each indicate different things, but in its simplest form, they give us an indication of what the economic situation here in the United States is. The S&P 500 is probably the most recognizable one out there. It looks at 11 different industries, and it measures 500 companies. Now, this is not to be confused with a stock exchange, because the S&P 500, there's no trading happening inside of the S&P 500. It's just that a company named Standard & Poor, that's where the S&P comes from, and the S&P 500 measures the 500 largest companies across 11 different industries here in the United States. And traditionally, they've given us an indication on how the overall economy is doing.
And so the three that you talked about, they're each benchmark for a different segment of the economy?
Ironically, yes and no. They all, for example, the S&P 500 and the Dow Jones industrial average, S&P 500 looks at 500 companies. The Dow Jones looks at 30 companies that are the leading companies for each of the industry, but ironically, they look at the same 11 industries are represented there. But, they have different measurement as to which stocks are going to make the index.
Okay.
One is, managed or the index is managed by S&P, Standard & Poor. The other one is by a company named Dow Jones. That's why it's called the Dow Jones Industrial Average. So they look at different things but the measurement is about the same. They want to see how the overall economy is doing. They just use different metrics.
What is the health of the economy? And this is what's going to tell you.
Yes,
So
exactly.
when people talk about the market being up or the market being down, are they talking about one of these three, or are they talking about the average of these three?
It depends on which one you look at. Over the last 50, 60 years, the S&P 500 and the Dow Jones, they've moved almost in unison. If one is up, the other one is down. Very seldom you're going to see one that's up and one is down, but they're usually within a few points of each other because they're trying to measure the same thing. They're just doing it a little bit different.
Okay. So we're not being specific if we're looking at the Dow Jones or the NASDAQ.
Right.
We're looking at just as an overall picture when we say there's a
Right.
market up and down.
Right.
It's just the overall picture.
And to do that, I think the S&P 500 would be the best one to kind of get an idea of what's going on out there because the sampling is larger. It's 500 companies
Right.
and it's 11 different industries
Okay.
that we're looking at. So it is probably the best one to track if you want to know what the sentiment is from investors at any given time.
Okay. Okay. What about stock trading? What is that?
Stock trading is just buying and selling of stocks either in an exchange or through a broker dealer. Most of us individual investors, we're going to trade through a broker dealer, an investment company like many of them out there. You have the E-Trades of the world, the TDs of the world. Then you have the companies that do things like LPL Financial, we're managing clients' assets. And then we have our own clearinghouse to the exchanges to buy and sell and manage our clients' securities.
Okay.
But in its simplest form, is simply the buying or selling of stocks in an exchange.
And you can put in there different measure or benchmarks. So if the stock goes below this, buy. If it goes above this, sell. So you can do all of that within the TD or Ameritrade or the broker, right?
You can. There's a lot of strategies out there that individual investors that are doing their own trading can utilize. They can do. They can say, okay, if the stock hits a certain price on the upside, sell it, give me the cash. If the stock goes down, it's called a stop loss. You can put a stop loss that says if the stock goes down by X amount of dollars or by a certain percentage, you can go ahead and set those parameters on your trading tool and it executes according to what you've instructed the system to do.
And that's just risk management too,
that's
right?
Just risk management. Yep.
Okay.
Yes.
We hear of the bull market and a bear market. Can you tell us what those are?
Yeah. Those are phrases that were coined by stock traders back in the day. The sentiment is that in a bear market, the market has dropped at least 20%. And when we mean the market, we mean the major indices like the Dow Jones and the S&P 500. So when we see those indices drop by 20%, that's called a bear market. Anything more than that, we get into more of a crash, what's described as a stock market crash, when it just, from there, it just continues to drop like what we saw here in March and April. The bull market just indicates, again, the sentiment on the other side, where people feel confident about where things are in the economy and money's coming back into the stock market and the indices going up, just like what we've seen since mid-April through now, with stock markets hitting all-time highs.
Yeah, and we're at the end of this, we're going to talk about that because that's very confusing to me, who doesn't do a lot of stock market trading. I rely on people like you to do that for me. But and you touched on this, but what is the difference between a stock market correction and a crash?
Yep. Stock market correction is anything up, 10% or above correction. So if the major indices drop by 10%, it usually, the alarms are not going off. There's no sounding of alarms. Oh my God, oh my God. It's just the market does that. On average, it does it at least once a year. It is possible. Yep. It is possible to go through a couple of years where we don't see a pullback like we have in recent times, but that's basically a correction, 10% or more, but less than 20.
Okay.
And the recovery factor usually is very quick. You know, it drops 10%, people go, oh, there's nothing to see here, and then they come back in, and we see a quick recovery from those usually. Stock market, a bear market or a crash is, you know, 20% or more, and it depends on how quickly we get to that. Over here, you know, that's recently in March and early April, we were seeing swings in the stock market of 10, 15. At one point, it was 17% in the intraday trading. We saw some days where there was just pure fear happening. And so we occasionally see those.
In 2008, when we went, boom, do you remember how low that went?
Yeah, we had actually, and that is something that, like you said, this has been a very confusing recovery, because back in 2008, if we look at the fourth quarter, right around October, when the financial crisis really began and it hit its peak, the market was down at one point almost 40%, 38, 40%. Then there was a little bit of recovery, and then it went back down. And at the bottom in early 2009, the S&P 500 was down just over a little over 50%.
Wow. That
Before we started to see, yeah. And those two major pullbacks happened within a couple of months. There was a period where people saying, okay, maybe the worst is over. And then we got hit again in early 2009 when the stock market went back down.
I'm going to go, we didn't talk about this, but how is it dictated? In other words, like, we know that when there's fear and lack of confidence, things will go down. Is it the investors who have big money in the stock market who really determine, okay, this is a real fear, it's going to go down, we're going to pull our money out? Is that dictated by the investors, the big investors who have lots of money in the stock market?
In large part, yes. But, you know, it is 2020 where, you know, we live off our cell phones, right? I mean, there are trading platforms that you can do anything that you can do on your desktop, you can do it on your cell phone. And, you know, we have a large number of people trading daily. And, you know, there is nothing guiding an individual investor that's doing their own trading other than their gut feeling. There is also, there's been a lot of talk about trading algorithms that a lot of investment companies use, where if something happens, then it trips a buy or a sell. So there's a lot of factors here at play, but normally if the sentiment is very pessimistic and you have that, oh my God, I think it's across the board where you see a massive sell-off. It's all of those factors at play.
Yeah. And it's funny because it snowballs, doesn't it?
Yeah.
You've got the fear, and you watch the drop, and people are watching that and like, oh my gosh, things must be really bad, and they drop. Yeah. And then the consumer confidence fails and it drops. So it's a snowball effect. It's very interesting.
Yeah. And traditionally, you know, that can last months. I mean, the recovery that we've just saw in the last few months, it's not an average recovery.
Yeah.
So usually, you know.
Did you expect that? Did you expect that recovery to be?
I did not. I don't think a lot of people expected.
I heard like a W recovery.
There are several types. You know, we were expecting maybe a W type of recovery. Then there was talk about maybe it was a square root where you had the peak, you had the trough, peaked a little bit and then flat. And there was a lot of talk about that, but again, nobody knows. Nobody can predict the future. None of us have that crystal ball. And certainly, you know, we're still in a recession and we're seeing all-time highs. So this is not a normal recovery.
Yeah. Well, let's talk about that. What is the difference between or the purpose of diversifying, and why should we diversify? Especially in times like this when there's not really a rhyme or reason to what's happening. Why is diversification so important?
Yeah. Look, diversification is basically don't put all your eggs in one basket, right? So for example, do you want to invest in the S&P 500 where you're diversifying across 500 companies? Or do you want to invest in a handful of names, in a handful of stocks? Well, the trouble with a handful of stocks is, what if you pick the wrong ones? What if you pick ones that you're not comfortable with, right? You like them on the way up, but on the way down, it just really, the sidekick is, oh my God, I'm going to lose all my money. So diversification is not as simple as not putting all your eggs in one basket. It depends on the basket as well. It has to be linked to your risk tolerances and your goals. And
age plays a role in that too, right? If you're in your money making earning years versus close to retirement versus I'm an hour and a half away from retirement, and
right.
the risk that you are willing to accept may change over time depending on how much work you have in front of you or behind you, right?
Yeah, it can't. That's traditional wisdom tells us that as when we retire, we have to be more conservative. But if you think about it, when you retire, let's say that you retire at 65, the average retirement period is 20 to 25 years. So if you take the growth component out of your investment, when you still have 20 to 25 years to depend on it as you're drawing, what are you replacing it with? Right. So there is a fine balance that still needs to be met when you're retired, because you cannot remove 100% of the growth components out of your retirement funds, even when you're retired. And sometimes I argue that that is the time that you should continue to be invested. Maybe a little bit more surgical about where we put the money to work, but you have to have some kind of growth component in most cases, at least for most of us that don't have millions to depend on to cover those 20 to 25 years.
And what is a mutual fund? So we talked a lot about stocks. What is a mutual fund?
That's a great question. A mutual fund, they've been around for a very long time, almost 90 plus years. In its simplest form, a mutual fund is basically a pool of money, pooled money from investors. And that pool of money is used to buy the stocks or the bonds for that specific mutual fund. So the mutual fund can hold stocks of many different types. In fact, there are mutual funds out there that aim to mimic the S&P 500. There are some that have 100% bonds of different types, and there are some that have a mixture of the two. So it depends on what the objective is or what you're trying to accomplish. You just simply, the mutual fund company collects money from all investors. They collect that money and they use it to invest in the fund.
Good. And one thing that I read this morning was that Buffett earned the majority of his money after he was, in fact, I think it was over 90% of his wealth after he was 52 years old.
Right.
Which I loved because I'm close to that age. So I have a lot more time to become as wealthy as he is. I think he's 90.
So he just turned 90 last week.
Yeah. Amazing.
Yeah.
So it's never too late is my point in that some people lost their jobs. Some people lost a lot of money during this. Some people have gone bankrupt. There are people that had to go into a foreclosure or they're pending a foreclosure or a short sale. And so I want to remind everybody that it is never too late, that there are second chances and there are ways that you can recoup loss by doing smart things and talking to smart people. And one of the smart people that I talk to is you, and we'll have your information up at the end. But before we go, I have two more questions. Yep. One is, how is the stock market doing amidst COVID? And then how does an election year play into the stock market?
Yep. So let's take them piece by piece here. The stock market is hitting all-time highs, right? So let's step back for a moment. What happened, right? We had this pandemic that no one expected. For 2020, we were expecting a decent year. We were still expecting a decent economic expansion. We were, earlier in the year, unemployment was at a record low. So we were heading into a pretty good year until COVID hit. So markets, basically we had a stock market crash in March and April. Then we had an unprecedented response from lawmakers and the Federal Reserve. The Federal Reserve said, look, we're going to be buying assets from banks and corporations to provide liquidity to the market. That was one of the first things that took place. Rates dropped. That's to, again, facilitate an ease of liquidity out there. We also had stimulus money that came into the market to the tune of almost, a little over $6 trillion. So all of that money created an unprecedented stimulus. And let's face it, it created a lot of confidence for investors. So that's probably the three biggest contributors to where we are right now in the stock market. Now, I would candidly say the stock market is not necessarily an indicator of what the overall economy is doing sometimes. We sometimes can have a disconnect. Like now, we have almost 11% unemployment. As you explained, we have people who are making the decision whether they're going to go through the foreclosure process, forbearance, people who may be afraid to put their house on the market because the uncertainty of things has some people frozen. People who have lost their jobs, people who are living off their retirement savings right now because they don't have any other alternatives. So there's a disconnect, but simply the amount of stimulus that came in to the economy during the pandemic and continues to come in the form of low rates and continued purchasing of assets by the Federal Reserve, providing more liquidity, is definitely contributing to the confidence of things right now.
Is it a false confidence, though, because of how much money the government is putting in through the stimulus packages? Because eventually they can't continue to do that, right? So
Right.
Is it a false security?
No one knows, but it is confidence nonetheless that things are, that we're not facing this alone.
Mm-hmm.
We have a government that's willing to do whatever it takes to keep things afloat.
Yeah.
And it has helped a lot of people. I mean, there's still a lot of people that need help, but it has helped a lot of people from disaster.
Yeah.
So as far as whether it's false or not, I don't know. I don't think anyone knows. And all we can do is just to take a look at our own individual situation. And are we in the best place possible? Are we doing the things that we need to be doing ourselves and to make sure that we come out of this okay?
And the other thing too is hopefully with COVID, with some answers with COVID, and if we have the vaccine with COVID, as that goes away, the confidence will organically rise.
Yes.
Right. Which will add to the health of the economy overall.
Yes. And I think, that when we saw also the unprecedented response from the pharmaceutical community, from the medical fields, from the healthcare field, it was unprecedented. I mean, we had since all of this was happening, we didn't know what COVID-19 was. We knew it was a virus, mm-hmm. but there was no treatment. Mm-hmm. And look at where we are right now. We're on the cusp of having several vaccines out in the market. And, whether they'll be ready for 2020 or early 2021, that's to be seen. But I think that's also instilling confidence that there is something being done, that we'll have something that's going to address this pandemic. I think that's probably one of the biggest confidence boosters that we're seeing right now.
Good.
You also mentioned the election. There's a lot of things that we can take a look at. This is a year when we have an incumbent running for office, and incumbents have done everything that they can possibly do, push for anything that they can possibly push to make sure that the economy is doing well. Because every single time that the economy has done well, the incumbent has won. Mm. The times where the economy has not been doing so hot, the incumbent has not won. Now, since 1984, that has been 100% of the case, right? We've only had one incumbent since 1984 that has not won re-election. We were in the middle of a recession. We had just come out of a war, and that was in 1992. If we go back even farther, it's I believe 1950 is the tracking of this data. 84% of the time, it has been the case, if the stock market has done well 90 days leading up to the election, the incumbent has been reelected. But this is not a regular year. This is 2020. We have a pandemic. And so it's 2020. So we don't know what's going to happen. I don't even know how a lot of states, how they're going to vote. I mean, there's still that big debate as to, are the polls going to open, or are we going to do mail-in voting? And so there's still a lot to be figured out until election day. And but we just got to look at the data that we already have, and take a look at our own situation again. And I'll leave you with this, the formula for success has not changed. We have to, number one, we have to invest. Number two, we got to reinvest our dividends. That's very important, because a lot of our returns are derived from the reinvestment, and the growth of those dividends. We have to invest for the long term, and we have to invest in quality, and we have to add money regularly. It doesn't matter if you're starting with $100 a month. You got to start somewhere. And over time, you will see positive returns.
I love that. I love that. Thank you for that success formula. Would you be willing to come on one day and talk to us about how to determine a good solid stock? Just give us a couple things that you look for.
Absolutely.
That are trending, et cetera. Will you come on and do that for us?
Absolutely. I'll be happy to.
Okay. Kayla, do we have any questions?
We do not at this time.
Okay, thank you. I love your house, by the way.
Oh, thank you very much.
You're welcome.
That was Kayla.
That was Kayla, but I like yours too. But I can only see your wall, Pablo.
Well, my house is in the process of being built, so I'm in a rental, and I'm not hanging anything on the walls that I don't have to fix.
Yes, I hear you.
So we're still living out of boxes for the next few months.
Yes. Well, I don't blame you for not putting anything on the walls. You'll only be there a little while.
Yep.
So anyway, everybody, thank you all for tuning in. I appreciate it. Pablo, we thank you so much for coming on again, and being our partner here and learning about the financial side of just the markets, et cetera. And if you guys feel that this was helpful, or know somebody that is interested in learning more about the stock market and thinks this would be useful information, please share this with them. And if you have any questions for Pablo, anything about financial planning and et cetera, all about stocks, all about mutual funds, anything like that, please feel free to reach out to Pablo. This is his information here. And Pablo, we thank you so much for tuning in.
Thank you for having me, Diane.
You're welcome. Take care.
Thank you. Okay.
Bye, guys.
Bye-bye.